Hey, everyone. It is Ashley and Bill with another mortgage moment. I'm Ashley Tellis, a real estate expert here in the Dripping Springs area. And this is my comrade, Bill Roegelein, a money man in all of Texas and a few other states. And today we're going to talk about weird. So in Dripping Springs, we joke that we're just west of weird. So what happens when you have a buyer that's a little bit weird when they go and apply for the loan? Meaning they're self-employed, or maybe they've realized that God's country is in the heart of Central Texas and they got to get here, but they don't have a job here yet. Bill, what are you doing for these folks?
Yes, it's a great question, and it came up a lot around the pandemic time, and especially nowadays with unique situations or unique individuals on how can they still qualify for a loan. So back long time ago, before we were the mortgage industry was regulated, pretty much you needed to be able to fog a mirror and you could get a loan. It was that easy with guidelines and regulations put in place. We've got to follow different guidelines, but what we call non-QM products, a non-quality mortgage, it's not your standard cookie cutter loan that you would do with the conventional, but there's situations where there's investors out there and different brokers you can use to try and take advantage of unique opportunities or unique borrowers. So I'll list out a few and just give situations and break down just in case that could educate someone of, hey, I never thought I could buy a house, and maybe this falls into my wheelhouse for what happens in my situation. So a few things that come up for self-employed borrowers you mentioned is the standard for self-employed borrowers is you need at least a 2-year work history with this business to try to use income. But there are ways around it. So again, using one of these products, we call them bank statement loans. So what this means is we can review 12 to 24 months of bank statements. So if I've had my business for 12 months, we would review bank statements, look at the income that comes in from your business. And we use calculations on that to do an average of what kind of income you're bringing in, minus set expenses that you might have for your business. And we can use that as monthly income right away to help qualify the individual. We don't have to wait that 2-year period. Situations where, hey, I file taxes. My tax returns aren't maybe that fruitful, depending on how much deductions I'm writing off and so forth. Again, bank statement opportunities are out there to try to use income, that the real stuff that you do bring in. So it's something that is used quite frequently now, and we're using it a lot more for individuals in those scenarios. Other situations, and actually I'm doing right now, is asset depletion, where
What's that?
yes, the borrower. So asset depletion, borrower has no job right now, but they have all this money saved up, retirement, money market, and so forth. So no income is coming in. So what a program we're using is just, we call it asset depletion, but we're using their total assets. So this is anything liquid, retirement, stocks, and we're coming up with this amount of money that they have saved up. And the individual program I'm using is we are factoring what it costs to do this loan. So the purchase price of this house, we're taking an effect of any debts that they have to pay that's currently on their credit report, things like that, closing cost. And we ask for a few reserves. And more or less, if they've got enough money to cover all of that, then we can get them qualified for a loan. That simple. We don't even look at income. It doesn't even come up. A job doesn't come up. It's solely based on how much money that they have on hand. So again, very particular situation, but it comes into play where, hey, we can get someone on board qualifying for them. One thing that we do use, this is more conventional, but some people don't know, is, well, I can't qualify for myself. What do we do? Well, we call it a non-occupying co-borrower. I can get my mom, I can get my sister, I can get my brother, I can get an individual that won't be living in the house and add them onto the loan to try to get them to help qualify with more income. Yes, that individual's tied to the mortgage, but hey, they can refinance out of that later down the road. Hey, my job's kicking in, I've got more commissions coming in and so forth. I just kind of in a pinch to make something happen sooner than later. Other items, investment properties. Hey, again, no income type documentation. They call it a DSCR loan. Is we base loans just on, hey, what the mortgage is going to be on the investment property. I'd use you, Ashley, to say, hey, we need to look at comps for this property. What are rental comps for this? We start looking at averages of, hey, what this rental amount might be for this property, and what we call a one-to-one scenario. If your mortgage is $2,500 and we can get $2,500 in rent, we call that a one-to-one scenario. It covers your mortgage. We can qualify a loan based on that alone. Even if the rent's not there yet to cover the full mortgage, there's still an opportunity for you to take advantage to get a mortgage. We don't look at income. We don't look at your job. We don't look at debts. We just look at what that monthly payment is compared to what you can get for rent. So, hey, you're trying to build your investment portfolio and you know you're in a pinch with income and debt, stuff like that. There are opportunities to get in and purchase a property. Just remember, most of these programs, you're probably going to be looking at least 20% down for most of them. Okay. And that's probably a big stipulation. So make sure there's some money in the bank to put down for a down payment, but 25% down and so forth. And I think one more to touch on is, hey, I am maybe new to the country. I've got a job. I don't have a social security number. There's no way I can buy a house. Well, yes. Again, back to these investor programs we can use. They call them ITIN loans, but without a social security number, which is mainly, the most important thing with the VARA is to have that kind of documentation. Is we can, there is a program out there for an individual to qualify that does not have a social security number yet. Again, probably 20% down, more than likely. But I guess the moral of the story is don't feel like you can't get a property or get a house because your situation feels unique and someone's told you that there's no way. You need a job. You need to be working in that job for 2 years. You need to have a business established for X amount of years. It's about being creative, knowing your environment, knowing your people to see maybe how this fits into their situation.
Man, great info. And Bill, we don't talk about this enough. How can people get a hold of you?
Plenty of ways. Phone number, it's directly to my cell. I don't have an office number, so it hits me anytime. My email. So I don't know if we can post it up, but
absolutely.
We can get the cell number and the email. Listen, I don't work banker's hours either. We know weekends are a prime time for people to go shopping and be in the hunt for a property. Just know I'm available also.
Well, you guys got the skinny on all things weird for borrowers. Thank you for joining us for this week's Mortgage Moment. We will see you guys soon. And if you have any questions, like Bill just said, hit him up by phone or email, literally anytime, day or night, and he's going to be able to answer your question and get you to the finish line on your opportunity. Thanks again, Bill, and we'll see you next week.
Yep. Talk to you soon.